We may see higher interest rates before the end of the year. In a much anticipated speech yesterday at the central bank's annual Jackson Hole Summit, Fed Chair Janet Yellen expressed optimism about the U.S. economy. For more on that, we are joined by Vera Gibbons. She is a financial expert and senior consumer analyst with GasBuddy.com. Good morning.
Good morning.
Despite that optimism, the market's closed a bit down.
Down a little bit, but, sort of a muted response to Yellen's comments. I think because there were no surprises, no shocks. It's sort of status quo. They're expecting a hike at some point, probably toward the end of the year. I think the market just took it as nothing happening anytime soon. The market wasn't spooked.
Okay, but Yellen did. She said the case for a hike has strengthened.
Yes.
A little bit.
Yep.
There's a shift in tone here. Yes.
There is a shift in tone, and that's because of optimism about the economy. Job growth has been very good, particularly over the past couple of months. If you look at June, July, and August, average jobs there, 190,000. If you look at just June and July, over 500,000 jobs created. So she's optimistic about that, optimistic about the economy. And of course, consumer spending has been very strong as well. So that's been propping up the economy and raises the odds for that hike.
If there is a spike, though, when do you think it will happen? When should we get our mortgage locked in?
Well, this is the million-dollar question, right? So Yellen was very ambiguous about that. Doesn't want to jump in there and start spiking up hikes until they know that the economy can withstand the hike. So very ambiguous on that front. And I think the ambiguity that we saw raises the odds that we won't have that hike until the end of the year. That's certainly what the market is expecting. But monetary policy, there's no really set course. It depends on inflation, wages, jobs, what the economic outlook looks like. So there's a lot of different moving parts, and the Fed will, decipher that economic data down the line before they make a decision.
We got a jobs report coming this Friday. I mean, is that going to seal the deal here, do you think?
All eyes will be on that report, Anthony. Yeah, that's a big one. The expectation's not as good as the July report. I think they're expecting 180,000, 190,000 jobs to be created. July was 255,000, so a lot more. But I think that potentially has enough to tilt the Fed in the direction of having an interest rate hike sooner rather than later. But, look at the negatives here. I mean, business investment has been sluggish. U.S. exports have been held back by the strong dollar. The economy sort of muddling along with economic,
not great,
not good the last round. So I think that these headwinds may stall the move from the Fed.
What about November, though? I mean, we're going to have a new president. Do you think that the timing of all of that could affect this decision for the spike?
I don't think we'll get it. I don't think we'll get a hike before the election. I mean, the economic impact of, say, 25 basis points would be small, but I think the symbolic impact of an increase would be way too significant. I don't know that Yellen wants to get into the middle of playing politics and getting into that political fire necessarily. And historically, that doesn't generally happen. So we'll see, though. This is a strange election cycle, as you very well know.
Yes, we've mentioned that once or twice.
Yes, you have.
We've noticed.
Vera, thank you so much.
Thank you.